You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi everyone, it's Jake here. Welcome to The Voluntary Life. One of the main topics that I talk about on The Voluntary Life is financial independence and different ways of achieving financial freedom for yourself. And I've spoken many times about my own approach to investing. I'm a strong advocate of passive investing, and I follow a particular investment strategy called the permanent portfolio, which I think has a lot of benefits for individual private investors. However, it's not the only approach to investing, and it's not the only option available to you if you are a private investor and you're working towards your own financial independence. So I thought it'd be interesting to get the perspective from someone who follows a different approach. In this episode, I'm going to play you an interview with Robert Marstrand, who is an investment blogger who follows an approach called value investing. I hope you find it interesting to hear a different perspective from mine. And we talk about the permanent portfolio too, so you get to hear an outside perspective on the approach that I've taken. So without further delay, here's my interview with Robert Marstrand. I'm very pleased to have a special guest on the show. It's the founder of the investment blogging website Ofwealth, Robert Marstrand. Hi, Robert. Welcome to the show.
Hi, Jake. Thanks for inviting me to talk.
I thought it'd be interesting for us to talk. One of my listeners recommended that we talk because I think your story and your background is relevant for a lot of the topics that I cover on The Voluntary Life, and in particular issues to do with investing, financial independence, but also internationalization and living abroad. And more broadly, I think, I've talked to a lot of people who've chosen a slightly different path to many mainstream career paths. And I know that you had a very traditional career in banking, and now I believe you're talking to me from Buenos Aires and you're doing something very different. So for my listeners, I thought it'd be interesting to hear, first of all, about your background, how you got to be where you are in Buenos Aires from being a banker in the UK.
Yeah, well, if we go right back, as you can probably tell by my accent, I grew up in England, in southeast England. Lucky enough to live in the country when it was not going through one of its periodic wars, which was nice. So we had a pretty peaceful upbringing. To be honest, as a kid, I didn't really travel internationally. We didn't take foreign holidays. The furthest we ever got was Wales. And it was only as an adult that I started exploring that side of things. So after university, went into a big investment bank, which turned into something called UBS, which is a big Swiss outfit. I spent 15 years there, which was a great learning experience, but I ultimately decided I'd had enough of the long hours. But as part of that, one of the great things was I managed to secure a posting in Asia for a few years. So I spent some time out living in Hong Kong, but working all around the region. So that opened my eyes a lot, especially to the huge growth that's going on in the Asian region, which is absolutely spectacular and ongoing to this day. And then, I came back to London after a few years out there, and just didn't like going back to the big company central office kind of bureaucracy that I encountered there, and sort of became increasingly fed up with it all. And then it became clear that there was some kind of financial crisis brewing, although I don't claim to have sort of foreseen how exactly enormous it was going to be, which started in 2007, but we tend to think it was in 2008. And I got to know Argentina, I suppose, from about 2002, which was just after its last major financial crisis and debt default. And I liked the place, and I had an Argentine wife, and was looking for a new place to sort of do something new in the world. And kind of partly because I knew it, but partly by a process of elimination, I thought it would be a great place to live. I don't know if you know Buenos Aires, but it's it's a beautiful city to live in. So,
yeah, we lived there for a month a few years ago, and I loved it. I thought it was a really beautiful place, and in many ways, it really exceeded our expectations. It's got a great cultural life. There's loads going on, but it also struck me as being an incredibly unstable place.
Yeah, look, absolutely. I mean, in terms of the kind of lifestyle, it's like a little pocket of Europe, basically, in South America, because most of the big immigrant groups were Spanish or Italian. Although you get people from all over the place, Germans, Scottish, English, you name it, if their families come from all around the world. And yeah, look, it's had decades and decades of instability, both politically and economically. But the city itself is just a fabulous place to live. And, compared to living in, say, London, where I lived for 12 years, you can live extremely well for a lot less money. So, that seems like a good deal to me.
Right. And apparently also just recently, hasn't it just become, I think the exchange rate has just changed significantly and it's become even cheaper. Is that right?
Yeah, well, yeah. I mean, the currency's devalued by about something like 55% since December. So we've gone from,
wow.
Yeah, which is a dramatic move, obviously, and a lot of people are upset and worried about it. But we've gone from a sort of position where the Argentine peso, in my opinion, was massively overvalued to one where it's sort of overshot to the downside.
Right.
I mean, I was always expecting it to fall, but maybe not quite as sharply as it has done so quickly. Because, the country has a pretty dreadful financial legacy left by the last government, which left office at the end of 2015. And the new government has taken lots of steps to rectify some of the problems, but they haven't, either by choice or because they haven't had the sort of political power, they haven't moved really quickly enough to solve the problems. So those include things like a big budget deficit and a big current account deficit, which is deadly for a country like Argentina.
Right. And I mean, when we were there, we had a great time, and my wife actually, I think Buenos Aires is still probably her favorite city, and it's a lovely place to live. But it seemed like, there are some things that do affect you, like power shortages, and there's lots of sort of demonstrations in the streets and stuff. How much does all of this affect you in terms of your day-to-day living there in Buenos Aires? And is this something that you really see on a daily basis, or is it very much something that it depends where you live and so forth?
Well, I mean, it's interesting you mentioned the power shortage thing. That was a big problem a couple of years ago because we had a populist government that was starving the utility companies of cash, basically, and trying to keep prices down. And they weren't investing in the infrastructure. So, yeah, we'd get regular power cuts, especially in summer when everyone switched on their air conditioning. But to be honest, it hasn't been an issue at all for the last year and a half, not that I've noticed. So things are getting better on that front as things become normal. In terms of day-to-day life, yeah, there are lots of protests. I mean, there still are. I think I saw on the TV news this morning there are 19 protests going on in Buenos Aires city today, where the traditional means of protest is a small group of people will block off a main thoroughfare and create sort of traffic chaos for a couple of hours and then go home.
Right.
But I live far away from the political centres. I live a little bit across town, and I don't see any of that trouble at all. The city, I've been here 10 years at the end of this month. I go out at night. As you know, here it's a very late night culture where nobody eats dinner before about 10 o'clock. So you don't get home till late. And I've never once ever felt remotely threatened by some sort of impending criminal problem or anything like that. It's just a very pleasant city with, great restaurants and bars and so forth. And you can live well. The side where you have to be a bit different, maybe to, say, living in the UK or a more stable country, is thinking about your financial side. So, I rarely keep much money in an Argentine bank. I keep it in other places, and I just bring money in when I need to spend it. Because, why would you want your money parked in Argentine pesos when we've got inflation running at 30 to 40% a year, and that inevitably means the peso is going to lose value and continue to lose value. So you have to be a bit more inventive about that side, and particularly that was true a couple of years ago because we were capital controlled. So you had to do all sorts of complex operations through bond markets to get money into the country legally.
Yes,
but it was fine. You soon adapt, and the Argentines, having seen decades of this, adapt very fast.
Yeah, is it the case that one of the sort of big hopes for a lot of people who are cryptocurrency enthusiasts was that a situation like that would be a really great opportunity for people to use cryptocurrency as a way to kind of get around some of the problems of a massively devalued currency. Do you see people doing that in Argentina?
Oh, absolutely. In fact, if anything, I'd say Argentina was a very early adopter of things like Bitcoin because there were strict capital controls in place. And at one point, it was very hard for people to buy US dollars, which are the usual sort of safe haven for cash in these parts. So yeah, it took off here pretty early. Now, whether it's got widespread adoption, I don't think I'd go that far. There are no capital controls now, and people seem to be happy with their, piles of $100 bills in safety deposit boxes.
Right.
But there's certainly, a higher level of interest here, I would say, than in most of the other places I go to, barring, of course, when we went through the kind of big speculative spike last year where everybody around the world got very excited about all of it. But just in general, yeah, people will try that stuff out. Absolutely.
Right. So you now do an investment website, and I know that your approach to investment is a little different because than the one I've talked quite a lot about passive investing and about the permanent portfolio idea. And I thought it might be interesting for people to hear a bit about your approach, because I understand that you're a value investor. I haven't really talked about value investing that much. Can you give a sort of brief background about what the idea behind value investing is and sort of what the principles are that you use?
Yeah, sure. I think at its root, value investing is basically a way to cut risk, but you have to look at risk in the right way. So the way I come at it is that, if you have a company that is generating a certain amount of profit and growing at a certain rate and has a certain, likely outlook in the future, it clearly, to me, seems to make sense to buy it when the markets offer up a cheaper price to you than when they're offering up a high price to you. If something's already low, I think it's less likely to fall hard from that level than if it's already trading high. At the same time, if you're talking about dividend-paying stocks, a very simple reality is that companies pay sort of fixed amount of cash dividends per share every year. And those tend to increase slowly over time or in line with the way that profits grow. But if the stock is cheaper, the shares are trading at a low price, the dividend yield will automatically be higher, all other things being equal for that stock of that company. And so therefore, instantly by buying at a lower level, you're getting a slightly higher level of return. Plus, you've got the prospect that as other investors come round to the realities of the company, that you'll get extra price appreciation as well. So you put those pieces together, you've got the company is solid, it's growing, it's doing okay, there's a decent dividend yield, and there's a chance that the price will go up simply as the other people realize that it's a bargain. Now, there are some drawbacks to that, or it takes a certain mentality, should I say. You have to be what's called a contrarian. So things are cheap for often bad reasons, but if you're going to go in and put your money in those, you have to basically go against the sort of accepted wisdom. You have to go against the crowd and be a contrarian. And that can take a lot of kind of willpower, and you need to be pretty certain of what you're doing. At the same time, these things don't pay off instantly. Chasing some momentum stock to the moon may give you results instantly. Buying something that's hammered down and ignored and everyone doesn't like at the moment, you're probably going to have to wait several years for it to really pay off. So you can collect the dividends in the meantime, but for the price to really get going, it could take, in my experience, it takes on average about 3 years to get a really good result. But it can take longer. It can be quicker, of course, but it can take longer. So you need to have a lot of patience and quite a bit of willpower and belief in what you're doing to do it. But I think, from my own experience and just from even the theory of it, the results tend to be much better than just buying an index tracker, which is indiscriminate about pricing.
Right. So I can understand what you're saying about being a contrarian totally. And I can see that is, you've got to have the guts to do that, especially if you're been bombarded with messages about some stocks being really worthless and you're looking at them as being actually really good value. But my question is, though, if for a lot of the people who listen to my show, there'll be individual investors who are thinking about their own future, planning for their own financial independence and thinking about the approach to take. I guess the question I've got is, in order to actually take advantage of this approach, you have to understand the value of that stock better in some ways than the market does, right? You have to understand that it's priced low for a bad reason. And doesn't that mean that you have to be a real expert in the companies that you're looking at?
To an extent, yeah. I mean, what I'd say is with this approach, you need to spend quite a bit of time on the analysis or getting to know the company and having the courage of your convictions and finding those devils in the detail that other people are missing. So, when I'm doing this for my my stock picking letter for paying customers, I will go through every page of, sometimes 400 pages of the latest annual report to dig out the real details, which, by the way, often puts me off things that I think are great ideas because I find something that maybe others have missed that I think is negative. And other times, you find actually the underlying position is much better than people are assuming. But it takes a fair bit of work. So you need to either find somebody who's skilled in this, or you need to dedicate quite a bit of time yourself.
Right. I think this is the approach that Warren Buffett uses. Is that right?
Essentially, I mean, he's what you call a Grahamite value investor. So after Benjamin Graham,
yes,
who's put down as being the inventor of value investing. And if anyone wants to read a good book, although it was written a long time ago originally, I'd recommend Benjamin Graham's The Intelligent Investor.
Yes,
which gives you a pretty good overview, and it's not too technical either. It's pretty easy reading for most people.
And is that what would you say that you're also in the same vein, or do you have some differences of approach to that?
I suppose that basically the similar philosophy of buying things when they're cheap, but of solid companies that have good fundamentals. However, some of it has to be brought up a bit up to date. Some of the financial measures that we used 30, 40, 50 years ago are not so appropriate now for a lot of the kind of modern companies that we have and the way that they operate. But the basic principle is there. You're looking for companies that generate plenty of cash, pay a dividend, and have decent growth prospects. And at the same time, when you can buy the stock at a cheap level. By the way, I have no issue with passive investing either. Passive in the sense of index funds. I actually like index funds quite a bit. But I like to buy the index funds when I think they're offering decent value. And that in recent years has been reasonably difficult to do because we've seen some quite sort of exuberant sort of valuations on a lot of stocks, or there's certain things going on within indices where a subsector is in sort of bubbly territory, which increases the risks. But overall, whether it's individual stocks or country funds or whatever, I think there's room for all of that in anyone's investment portfolio, and I certainly personally use all of that.
Right.
It's just I'm selective about where I go.
Yeah. I thought it'd be interesting to hear your thoughts because we spoke briefly about the approach that I've adopted, which is the permanent portfolio idea. And I know that as a value investor, you see things slightly differently. And I think you mentioned that one of the concerns that you have about the permanent portfolio is the use of gilts or long-term bonds. I think it'd be interesting for my listeners to hear a different perspective because I talk about the permanent portfolio a lot. What's your perspective on the permanent portfolio and any issues that you see with it?
I mean, I like the basic idea of the permanent portfolio, which is to have a split of 4 asset classes. And I think you're supposed to do a rebalancing, once a year?
Or when you hit a rebalancing band.
Okay. So when it gets out of whack, you sort of put it back to the even split of quarters.
Yes.
And if I recall rightly, you've got stocks and shares, gold, government bonds, and cash. Is that right?
Yes, that's right.
Okay. So I sort of follow a similar approach, but maybe a slightly modified one, essentially. First of all, I don't have fixed asset allocations in those fixed quarters. I sort of trim them a bit up or down, depending on how I see things.
Right.
But right now, for my own readers, I've been recommending a split of stocks, cash, gold, and specifically long-dated US Treasury bonds. There's a rather specific thing on the bond side, simply because they're a kind of safe haven if stock markets crash. But it's a sort of similar basic principle that you spread the money around between different asset classes.
Yeah, that actually sounds quite similar to a permanent portfolio mix.
Yeah, no, it is fairly similar, but the allocation to bonds is much lower than you'd have in the permanent portfolio. The allocation to gold is a little bit lower. And right now, there's a bigger allocation to stocks and cash, for various different reasons. But this basic sort of similar sort of basic principles of having stuff spread around different asset classes, and then within that, picking the best stuff that makes sense. So on the stock side, being a value investor, yes, own stocks, but only where the prices make sense. That's my kind of general guidance. On the going back to the permanent portfolio, which, I don't remember when it was first invented, but I guess it goes back to the 70s or something.
Yes, I think so. I think it sort of started in the 70s and got finalized in the mid 90s.
Right. So that would have been a spectacular portfolio to have throughout the whole period from the early 80s until probably about 2 years ago, because both on the stock side and on the bond side, you were basically in these long secular bull markets where yields were coming down, prices were going up. So you win on both sides. You just rebalance every year according to which one had done slightly better against the other. My issue with it in recent years has just been that the bond yields have been so spectacularly pathetic that if you buy a 10-year government bond that's yielding 0.5% and you hold it for 10 years, you're going to make 0.5%. And that just didn't seem like something I'd want to lock lots and lots of money into. I mean, just give you some numbers now. Even now, yields have come up in some places, but even now, you look at the US is now yielding just under 3% on the 10-year government bonds, which is okay-ish, but still only marginally above inflation. UK is 1.5%, which is way below inflation, so you're losing money in terms of buying power. Switzerland is still negative yields. Japan is 0.1%, Germany 0.4%, France 0.6%. These are really low yields still. So that's why I'm just kind of reticent to have a bigger allocation into that piece. But I did put a little bit in there for US Treasury bonds just because they're a safe haven if stock markets take a big bad turn.
Right. Yeah, it's a really interesting time. I mean, it's so weird what the bond market, and it's definitely a bad situation as far as yields are concerned. The capital value has increased because interest rates have been pushed down, but still, I understand that perspective.
I mean, of course, cash is also ultra low yield, but cash doesn't have any price volatility. So the way I look at it is it's, on the one hand, it's ballast, what I call ballast. So whatever happens to the other pieces of the portfolio, it kind of steadies the ship in uncertain times. And I also call it ammo. So which you will get from time to time, stock markets crash, not always logically, but they do correct massively from time to time. I think on average, since the sort of late 19th century, it's on average once every 6 or 7 years, you have a big downturn. That cash is there to then go and scoop up some stuff that's oversold and very cheap. And then you make loads of money coming back out of the situation
on the bounce.
As things settle down.
Yeah.
So the money's kind of, especially with low yields right now, the money's kind of dead while it's there for a while, but then it makes you a lot of money in future, hopefully, when you can pick up stuff at a bargain level.
Right. I know that another one of the assets that you have a slightly different take on that is within the permanent portfolio is gold. You mentioned that you hold less than there wouldn't be in the permanent portfolio. What's your perspective on investing in gold?
Yeah, well, I do like gold. I specifically like physical gold. So, I would recommend preferably that people buy gold coins, which basically they never sell. It's just like an insurance policy. It's money that you've got forever, unless you really need to dig into your iron reserve, if you like, or gold reserve. But also buying bullion, which is easily done online these days. There are a number of competing services, but they're all more or less similar. The fees vary a little bit between them depending on exactly what you want to do. There are slight pros and cons, but you can do that very, very cheaply and store physical gold all around the world in vaults. You buy pieces of bullion bars, basically, that can be in London, Singapore, Zurich, Toronto, New York, wherever you want. So I'd recommend that's the first point. I recommend physical gold if you can get it. So your direct personal property, not gold funds like ETFs, ideally. Although they're okay. They're okay in a brokerage account, but physical if you can do it.
Yeah, just to say, I think that's exactly the same guidelines that Harry Brown had in terms of owning physical gold, and I can totally see the rationale behind that as well.
Yeah, no, absolutely. But it's not essential, but it's a preference. That's all. So then, why own gold at all? Well, the typical one is that people would say that, well, it's hard money and it's a sort of catastrophe insurance if there's a meltdown in the financial industry, which is, by the way, true. And I agree with that kind of viewpoint. But I have a slightly sort of additional viewpoint, if you like, that in the short run, the gold markets are dominated by paper speculators. for taking huge long or short positions that drive the gold price up or down in the short run. But looking out over the sort of longer term, I think the story is one of growing consumer demand, particularly in places like China and India, which obviously have huge populations and a growing base of personal wealth, and a great cultural affinity to gold in general. So over time, as those huge countries continue to get richer at a faster pace than most of the rest of the world, I think we're going to see gold demand only go in one direction. And when I say gold demand, most of that's for jewelry, but also for saving as well in physical coins and bullion and so forth. So I kind of describe gold on that basis as the ultimate consumer good. So it's indestructible, but it is driven by consumer activity, as in jewelry. That's the biggest piece of it. And over the long run, I can just see that pushing up the gold price as you get this wave of new money hitting a very slowly growing stock of global gold. My view is that gold goes up. Well, you've heard the idea of is it Roy Jastram who came up with the golden constant? The idea that gold over very long terms follows inflation, and you could buy a suit of clothes now with the same amount of gold as a Roman could have bought a suit of clothes.
Right. And I think someone, I think he actually tried to work out from records that it was approximately the same value, right?
Yeah, exactly. I think the work was done back in the 70s or maybe 80s. I'm not sure. I'd have to look that up. But I kind of think that we've moved from that now, and actually, given this huge wave of people that are getting richer, I think the long-term outlook, as that extra demand hits a fairly restricted supply, is that gold will go up slightly above inflation for many decades, with the short-term volatility, but the long-run trajectory being maybe 2 points above inflation. So maybe you're looking at something that makes 4 or 5% a year in dollar terms, something like that. And part of the reason I think that is that something that gets missed is that large pieces of the global population weren't allowed to own gold for quite long periods of time. So the famous one everyone knows about is that the USA banned gold ownership. Well, it actually confiscated gold and then banned ownership between 1935 and 1974.
Right. Under FDR, it came in, right?
Yeah, exactly. And I think it went away. Well, they took the dollar off the gold standard in 71, but then they took away the last limitations on private gold ownership in 1974. So they've got form, by the way, which means they could do it again. But the one that gets missed, I think, is China. So after the Communist Revolution in 1949, they banned private gold ownership in 1950, and stocks were confiscated too, obviously, because they were communists. So they banned private gold ownership. The country was also very poor for a long period of time, going into the 70s and 80s. And then they removed that restriction in 2004. So, just 14 years ago.
Mm.
And I think that was a huge part of the reason we saw quite a big bull market in the early 2000s, but then running all the way up until 2011 effectively, was that the Chinese had this combination of A, being allowed to buy gold again, and B, suddenly having the
money. Cash to do so, right?
Yeah. And I can only see that continuing. So, if you adjust for those bans in the US and China, and maybe there have been other ones around the world, but if you adjust for just those two things, the amount of gold per capita, so the number of ounces per person on the planet, has actually been falling since 1950.
Right.
So you've got population growth, wealth growth on the demand side, and a very slowly growing gold stock on the other side. So that's my case for why I think gold, in the long run at least, keeps going up.
Well, that's actually like a really nice little microcosm of a bit of value investing research, because the gold price hasn't done much in the last few years, but that what you're talking about is a longer term trend, which should mean that it's currently relatively better value, if you see what I mean.
No, absolutely. I mean, in the short run, what's happened is, well, I suppose a couple of things. One is that the other great invention of the last 15, 20 years has been gold-backed exchange-traded funds, ETFs. And that made gold much more accessible to ordinary people to own in their brokerage accounts or whatever, and speculate on the gold price. Now, that has positives in terms of opening up gold to more people. But the negative side is that if people sort of suddenly turn negative on gold, they dump their gold ETF positions, and a lot of money gets pulled out of the market and the price falls. And that's what we've seen since 2011 until fairly recently, is that the ETF holdings around the world just sort of came down rather sharply. And that was a large part of what drove the fall in the price since 2011. And it only sort of settled down maybe a year or a year and a half ago. And it's sort of went back up again and now down again this year a bit. The other part that drives things in the short run is interest rates, and particularly dollar interest rates, or more specifically real yields on treasury bonds. And those have been going up. And as they go up, people sort of see gold as a zero yield asset, doesn't pay any interest or dividend, and they sort of switch out into cash or short-term bonds or any kind of bonds to get a yield instead. In the short run, that clearly is a negative element too. But I don't think that changes anything about the long-term picture. If you look at the physical gold market, it's only something like 4% or maybe 5% of physical gold. The physical gold market is in the USA, despite the USA being whatever it is, almost 25% of the global economy. The physical gold market is somewhere else. It's in China. It's in India. It's in Hong Kong. It's in the Middle East. It's all those places. And ultimately, those are the things that drive the longer term trajectory. But in the short run, you've got this big paper speculation. You've got the ETFs, and you've got the trajectory of interest rates, which can weigh on things. So going back to what you said, yeah, when the price is down hard, that's a better buying opportunity than when it's just gone to the moon.
Yeah. Well, I think that's really interesting for people to get your perspective on this. And we've gone into some detail about some of these assets. So I think that'll be interesting for people. I want to finish by asking about your thoughts, given your own experience, because I know that you have been an investment advisor and you've obviously seen different people in different stages of working towards their own financial independence and different people making different decisions about what to do with their money. I want to ask you what you could summarize about some of the worst approaches and best approaches that you've seen for individual investors working towards their own financial independence. Based on your experience, what kind of typical mistakes have been the really bad things that people have done, and what have been the really good examples of people managing their money?
Yeah, sure. I mean, to start with, I'd say that first and foremost, before I'm any kind of financial advisor or someone giving people ideas, I'm a private investor. That's something that over my banking career, I managed to save some money and then had to work out what to do with it. And so everything I've learned, my whole approach to all of this is based on my personal experience and what I've seen work and what I've seen fail. And just like any other private investor, I've made mistakes. I've invested in stocks which I thought were a good prospect and turned out to not be as good as I expected. At the same time, I've invested in stuff that has done extremely well, more of the time, luckily. So, you learn from your mistakes, and over time you refine your approach. And that's why I've got to this point where value investing is the thing that makes sense, specifically makes sense for private investors. It's something I didn't cover earlier. If you'll just permit me to just mention this.
Sure.
Private investors, don't have to hit a benchmark, so that they're not getting paid a bonus at the end of the year. They're interested in how they do over 5 or 10 years, hopefully 20 years or 30 years. B, they get charged much higher fees and commissions, even if they don't see them, and they often don't see them. They're paying a lot more to the financial industry every time they make a trade. So one of the joys of value investing is that you don't have to trade very much. You spend a lot of time thinking about what to invest in. You put the money down, and then you're waiting years. So, on a portfolio of, 20 stocks, let's say, you might only trade 4 or 5 times a year on average. Now, that'll tend to be in fits and spurts. So you'll have long periods of doing not very much and then short periods of doing a lot. But you're not trading very often, so you're keeping your costs down. And over the long run, that makes a huge difference. So I got there by both my experience of working in the financial industry and seeing how that operates, but also my private experience of what's worked for me. And that's why I strongly believe this is the right approach for private investors, different for professional traders.
Right.
going back to your question on sort of, I think it was to do with how to achieve financial independence.
Yeah, exactly. So, the good and bad examples that you've seen on the road to achieving financial independence.
I mean, the most obvious thing is you don't get rich by spending money. That sounds really, really blindingly obvious. But what I witnessed in the banking world is, as people were earning more and more money, they were just increasing their lifestyles to fit their paycheck and not really saving anything.
Right.
And people get in trouble doing that. I've always taken a fairly conservative approach on that kind of stuff and made sure that I was saving hard and taking advantage of tax breaks when they occasionally get thrown at you by the government before they get taken away and that type of thing. But the main thing is just to make saving your top priority. So it's very unsexy and not glamorous, but rather than thinking what's left over at the end of the month that I can save, think when the money comes in at the beginning of the month, this is how much I'm going to save, and that's what I've got left to spend. So save. That there's no question that's the way to secure your financial independence, or that's the most important starting point. Now, just to illustrate that a little further, a very important point is a small cut to your spending will result in typically a very big increase in your saving rate. So let's say in a given year, you spend 95% of what you earn after tax, and you save 5%. If you trim that 95% you spend down to 90, you've only cut a little bit more than 5% off what you're spending. But you've increased your saving from 5% to 10%. You've doubled your saving.
Yeah.
So very small reductions in what you're spending result in very big increases in how much you're saving. So everyone should look at what they're wasting money on. In my case, I went through that process about 12 years ago, and realized I was wasting huge amounts of money on things like unneeded insurance, for example, contents insurance on the house, on stuff that couldn't be replaced if it was stolen anyway, and save thousands by just going through a process of eliminating that kind of stupid wastage that I've discovered I had. And I bet most people could do that if they just went through their outgoings, worked out what they're wasting money on unnecessarily, and just redirect that to saving, and you'll see your money start building. And then the final bit is, once you've saved it, is working out what to do with it, which is obviously what you and I are all about.
Right.
Because there's no point leaving it sitting idle in a low interest bank deposit that's going to lose value over time as inflation inevitably chips away at it. I mean, let alone in Argentina where it's 30 or 40% a year, but even in a place like the UK where inflation's maybe 2 or 3% a year over 10 years, that's going to chip away a lot of the value. So that's why you need to find these investments that at least beat inflation after you've paid your taxes due to the government. And that's, for me, whether it's bonds, gold, stocks, for me, stocks are the absolute winner. The historical record is clear that they're the best performing financial asset class. No, there's no question about that. Way above bonds and cash in every country in the world. And if you select them carefully, you can maybe do even better than that. Just one addendum to that: property can be a good thing too. So owning real estate and property for rental. The trouble is, it depends on your personal preferences, but directly owned property can be quite a lot of work.
Yeah,
difficult tenants, dealing with agents, maintenance, and all the rest of it. So you can even do that just through the stock market if you buy the right something called REITs, real estate investment trusts. You own a piece of property, pays you a fat dividend, and you get the same kind of returns.
I think that's a really good summary. I really hear what you're saying about the lifestyle inflation that can kick in when people start making more money. And I think a lot of people just don't realize that if you see people living, a very rich looking lifestyle, often they just don't have savings because they're spending it on that stuff. So I think that's a really good piece of advice. And I certainly have followed that approach to saving myself as well. Robert, it's been really great getting your perspective. For people who are interested, where can they find out more about your ideas and your approach and what you're doing?
Yeah, so I run a company called Ofwealth, O-F, Wealth, one word. There's a website, which I'm sure you'll put a link up to.
Yeah.
I write twice a week for free for anyone that's interested on what's going on in the world, particularly as it relates to the investment world. And so just have a look at the website, and if you're interested, sign up.
Great.
I'd be happy to have more on board.
Yeah.
And not least because my readers often write to me with their own perspectives and thoughts, and it's always good to hear from people and get more ideas that way.
Great. Well, thanks so much for coming on the show.
Well, thank you very much for the invite. It's been very interesting to talk to you.
Thank you for listening to The Voluntary Life. If you like this podcast, please show your support by becoming a patron of The Voluntary Life on Patreon. Your support will help to grow and improve the show, and you'll get access to a treasure trove of rewards, including bonus episodes. Visit thevoluntarylife.com to learn more.